After the Great Recession, inflation stayed low as the banking systems recovered. For many years, the inflation rate never exceeded 2%, but in recent months, inflation is making a comeback. Although President Biden has described these situations as transitory, many people are concerned that inflation will not go away. The overall increase in price in an economy over a predetermined period is known as inflation. The Federal Reserve typically targets a low and stable rate of inflation of about 2%, which can signify a growing economy. But because of economic shocks, inflation can rise into double digits. Inflation is a topic that has recently come up again, but remember, inflation does not prevent you from making money. So guys, stick with me as I take you through ways you can keep making money despite rising inflation. First, let's talk about investing in real estate. Single-family homes with low-rate fixed mortgages usually do well when inflation is high. Your home's value is likely to increase as inflation increases, but your mortgage monthly service costs will remain the same. Building home equity is fundamental to boost your net worth, which can happen very quickly. You can protect yourself from rising rents by investing in real estate. Rents usually increase when inflation soars, just like it does for any other consumable good. Despite having less flexibility than rental agreements, mortgages have a benefit when inflation is high. Value stocks. According to certain studies, growth equities typically perform worse during inflationary periods than value stock. Value stocks are businesses with high earnings in comparison to their current share price. They also have a reputation for having strong cash flows, which investors favor when prices are rising. On the other hand, growth stocks typically have a higher sensitivity to changes in interest rates, which is a typical monetary policy response to inflation. Growth stocks had a successful decade during the past 10 years when inflation was noticeably absent. Value stocks, however, has recently made a comeback. Their success is likely to continue given the current circumstances. Invest in commodities. Along with raw materials and other essential natural resources for productions, commodities also include gold and other precious metals. In other words, as demand grows, prices in the economy rise, and the cost of productions to satisfy the demand typically grows as well. Commodities are usually thought as a safe haven investments during turbulent times. Commodities are uncorrelated to the traditional asset classes of stocks and bonds and tend to move in different directions, even though they do not generate dividends or represent any underlying businesses. Invest in Treasury Inflation's Protected Securities. Tips. Treasury Inflation's Protected Securities, sometimes known as TIPS, are tradable U.S. Treasury securities created to stave off the loss of buying power. TIPS has the advantage of periodic inflation adjustments, a characteristic that standard fixed-rate bonds lack. TIPS should be considered as a component of a lower-risk portfolio segment by investors seeking capital preservation and stable purchasing power. Given that TIPS are backed by the full faith and credit of the U.S. government, holders can trust that they will receive their principal back. Invest in I-bond. U.S. savings bonds suddenly become an attractive investment during inflationary times. I-bonds are non-marketable securities that have a $10,000 yearly purchase limit and are guaranteed to rise in value over time. Like TIPS, they offer a nearly guaranteed return of principal. Investing in I-bond won't yield astronomical profits, but it will let you keep some of your portfolio's buying power. Consider cash and long-term bonds because many assets are expected to see real value declines during periods of inflation. Beyond equities that have a chance of keeping up, it makes sense to consider alternative options. Emphasize growth in equity investments. By buying high dividend-paying equities or growth and income funds, many investors attempt to balance out their equity portfolios, which can be particularly effective during times of market stability. However, accelerating inflation might reduce the returns on your investments. This is due, at least in part, to the fact that high dividend-paying equities suffer from rising inflations like how long-term bonds do. Putting most of your money into growth-oriented stocks and funds is a preferable solution. You should also prioritize industries like energy, food, healthcare, building materials, technology, and others that are likely to profit from inflation. They are all likely to fare better than other equity sectors since their prices will rise along with inflation. You can acquire particular stocks that have growth potentials or invest in these sectors through an ETF fund. For instance, the S&P Oil and Gas Explorations and Productions ETF or Vanguard's Healthcare Index Fund (VHT) allows you to invest in energy firms. Consider other alternative asset classes. If you are still unsure about what to invest in during periods of high inflations, you might look at several different asset classes. Since many alternative investments have weak or no correlations with mainstream markets, doing this can also be a smart move when markets are down. Investing in agriculture, wine, works of art, or even lending money to small businesses are a few examples of well-known alternative asset classes and how to invest in them. A platform for alternative investments like Yield Street, which offers a variety of funds and specific deals you may invest in starting at $2,500, is another option you should consider. Just keep in mind that some of these platforms may have higher minimum investment requirements and may demand accredited investors, but alternative assets are something to think about if you want to diversify your holdings and perhaps safeguard your cash from inflation. Convert adjustable rate debt to fixed rate. Although this isn't an investment move, however, it might be one of the best ones you can implement in response to rising inflation. When borrowing money, flexible rates are preferable to fixed rates during times of low or declining inflation. However, when inflation increases, the dynamic changes. Because higher interest rates are a direct effect of increased inflation, your adjustable rates will increase as inflation accelerates, maybe to levels that are no longer manageable. If you anticipate an increase in inflation, you should start refinancing your adjustable rate debt at fixed rates. This applies to your first mortgage, especially if it's an ARM, as well as credit cards and home equity lines of credit. To learn about your alternatives, speak with your loan provider. It's a smart idea to also review the loan documentations to find out when your rates will rise so you can make plans. If you refinance your mortgage, strive to keep your 30-year mortgage and reduce the payback time. Even if your monthly payments stays the same or increase, you will end up spending far less in interest. The expectations is that the inflation rate will eventually stabilize and start to decline as the Federal Reserve loosens its monetary policy and raises interest rates. But that will take time. For now, repositioning is important. As small additions of investments that often outperform in inflationary conditions could help your portfolio endure and possibly even thrive during this time of out-of-control inflation. Alright guys, that's all for today. If you found this video useful, give it a thumbs up and hit the subscribe button for more. Bye for now.